Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance and make it simple. Today we're diving into the latest shareholder report for BNY Mellon Equity Income Fund, and let me tell you there's a lot to dissect here, so buckle up. First off, this report is all about the fund's performance and financial health up to May 31st of this year. It covers the period from June 1st of last year, basically giving us a yearly snapshot. So the fund offers different classes of shares for investors: Class A, Class C, Class I, and Class Y. Think of them as different doors to get into the same fund, each with its own fees and features. Let's talk about costs. For Class A shares, investing $1,000 would have cost you about $108 in fees. That's a little over 1%. Now, Class C shares a bit more expensive, costing around $188 on that same $1,000 investment, about 1.78%. This really shows how those extra fees add up for investors. And then you have Class I shares, which are much cheaper, costing only about $83 for a $10,000 investment. That's less than 1%. This is typically for larger institutional investors who get better deals. Class Y shares are even cheaper at just $80, a $10,000 investment, or 0.75%. Again, these are for the big players. Now for the juicy part: performance. Last year, Class A shares returned about 12.66%. But here's the catch: the S&P 500, an index that represents the 500 largest US companies, did better, returning 13.2%, so the fund lagged behind the market. What happened? The report says the fund's focus on dividend-paying stocks hurt its performance, especially when compared to the S&P 500. Basically, they bet on income, but the big tech stocks that drove the market higher didn't pay much in dividends. Looking at the longer term returns here, we see the same trend. The S&P 500 has generally outperformed the fund's Class A shares over 5 and 10 year periods. For example, over 10 years, the S&P 500 returned 12.86%, while Class A shares returned 1.9%. That's a significant difference over time. The fund itself is quite large, with about $1.6 billion in assets. That's a lot of money managed by the fund managers. They hold about 102 different investments, which suggests a decent level of diversification. And for managing all this, they paid out over $10 million in advisory fees. That's a big chunk of change. The portfolio turnover rate is around 28%. This means they're not actively trading in and out of stocks too often, which can be good for reducing trading costs. Now let's zoom into the actual financial statements. The net asset value per share varies slightly between the different share classes, but it's generally around $31. This is the core of the report, showing exactly what the fund owns. It's a long list of companies. Most of the fund's investments are in common stocks, making up 99% of its assets. They own Tesla, which is interesting given the recent volatility in that stock. They also have a significant holding in JP Chase and a big position in Amazon. And of course, Nvidia, a major player in AI right now, is a big part of their portfolio, making up nearly half of their semiconductor holdings. The total cost of their investments is over $1.1 billion, and their current value is even higher, reflecting market gains. This statement gives us a snapshot of the fund's financial position on a specific date. The fund's net assets are around $1.65 billion. This is the total value of everything the fund owns minus what it owes. Here we see how the fund made and spent money over the year. They earned over $23 million in investment income, mostly from dividends, and they had a net realized gain of over $44 million from selling investments. But the big story here is the unrealized gains, which were over $97 million. This means the value of their holdings went up even though they didn't sell them. All in all, the fund saw a net increase of over $165 million. That's a pretty good year on paper. This statement breaks down how the net assets change from the beginning of the year to the end. They paid out over $106 million in distributions to shareholders. That's a significant amount of money returned to investors. Investors put in over $485 million into the fund, but they also took out over $400 million. This shows a lot of investor activity in the fund. These tables provide a per share breakdown of the fund's performance and key ratios over multiple years. For Class A shares, you can see the total return. In 2025, it was 12.66%, as we mentioned, but look at 2021, that was an incredible 41.26% return. That's the kind of year people look for. The expense ratio for Class A shares is right around 1%, which is pretty standard for an actively managed fund. And the net expenses after certain waivers and credits are also about 1%. The fund's net investment income as a percentage of assets is around 1.46%. This tells us how much income the fund generates relative to its size, not counting market gains. Again, the portfolio turnover rate is consistent at around 28% across the years. Shuffling now for my take on this BNY Mellon Equity Income Fund. They've got a solid chunk of assets under management and they're holding a good number of stocks, so that's diversifying. The performance in the last year wasn't spectacular compared to benchmarks like the S&P 500, but looking back at 2021, they clearly have the capability to generate huge returns. The strategy of focusing on dividend-paying stocks is a double-edged sword. It can provide income during down markets, but it often means missing out on the explosive growth from tech stocks that have been driving the market. The expenses are reasonable for an actively managed fund, especially for the institutional share classes. However, investors in Class A and C shares should definitely be aware of those fees and how they impact overall returns, especially when the fund's performance is already trailing the market. A key risk here is indeed that sector concentration and the impact of their dividend focus. If growth stocks continue to dominate the market and the economy stays strong, this fund might continue to underperform. On the flip side, if the market shifts towards more value-oriented or dividend-focused investing, this fund could see its performance improve. The past performance isn't a guarantee of future results, and that's really clear here. The big difference in returns year over year shows how volatile that strategy can be. Overall, the fund is well managed with a clear strategy, but that strategy might not always align with market trends. For an investor, it's important to understand this and decide if the dividend focus is what you want or if you're chasing broader market growth. Alright, that's a wrap on our dive into the BNY Mellon Equity Income Fund's latest report. What are your thoughts? Are dividend-focused funds the way to go, or are you sticking with broad market trackers? Let me know in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more corporate financial deep dives. And hey, if you want to connect with other finance enthusiasts and get more exclusive content, join our Discord community, linked in the description. Thanks for watching, and I'll see you in the next one.